Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, December 3rd. Sentiment in Europe is not that great as the continent is shaken by the worsening political quake in France. Sentiment across the pond, however, is quite cheerful with the S&P 500 posting its 54th record high this year to kick off the US jobs week. Oh là là, c'est la crise. France has stepped into the crisis mode yesterday after a series of events that included concessions from Barnier to make Le Pen happy, ended with Le Pen not being happy. So for those who missed and are interested in what's going on there, well, Michel Barnier made a second and a last-minute concession to the National Rally's demands by accepting this time not to reduce the medicine reimbursement, and that obviously came on top of abandoning the tax on electricity last week. Remember that? But it hasn't been enough, unfortunately, because Marine Le Pen wanted more of these concessions. Among her demands, the indexation of the pensions to inflation, for example. And because both parties couldn't agree on the budget, well, Barnier used a constitutional tool to push his unpopular budget bill without a parliamentary vote. And Marine Le Pen wasn't happy about that and said that she would take Barnier's government down by, joining the leftists in France in a no-confidence motion, and that could happen by tomorrow. So in summary, the things will probably get messier in French politics before they get better. That's the conclusion of the first day of this trading week. Interestingly, however, the market's reaction to the latest French drama was quite light to my taste for a country that actually risks to lose its hardly funded government in the next few days and also risks a potential government shutdown in the next coming weeks. The French 10-year yield fell to the lowest levels in 2 months, and the CAC 40 index closed the session near flat. But wait, the spread between the 10-year French and German yields jumped to 87 basis points, so that's the highest level since the euro debt crisis of a decade ago, and could well spike above the 100 basis points mark if the crisis is not contained. Now, of course, the widening French-German yield spread hammered the single currency on Monday's trading session. The euro-dollar sharply dropped to 104.60 level yesterday and will certainly remain under the pressure of the French political drama, among other problems that we see on the European continent. Because also remember that Stellantis CEO quit his position yesterday on tumbling sales and on tumbling profit, causing the shares to drop more than 6% at Stellantis, and around 66,000 Volkswagen workers abandoned their posts yesterday on failure to agree how to slash costs to avoid factory closures in Germany. Now, sell-off in Volkswagen shares remained curiously limited, but appetite was clearly not there either. Now, crisis equals opportunities that will allow some investors out there to buy French and broader European assets at discounted market prices. So next few weeks will probably be about watching and perhaps chasing a dip for many investors in many of these assets. Because the widening valuation gap between the US and European equities looks interesting and more interesting by the day for those who believe that the two continents cannot diverge forever. Maybe they could, we don't know. But for now, what happens in Europe stays in Europe. Because the US market's atmosphere yesterday was totally different, mind you. The S&P 500 actually posted its 54th record high of this year as record Black Friday sales came yet as another proof that Americans continue to spend. And Nasdaq 100 jumped more than 1% yesterday to near an all-time high level. Intel gained and erased its gains on news that its CEO was forced to retire on failure to turn the company's fortunes around, and watch the competition eat into its market share, obviously. Now, all eyes are on what the new CEO in Intel, that we don't know the name yet, will do with the foundry business. Because some investors out there think that Intel should actually spin it off to better compete with Nvidia, for example, which only designs its chips and lets the others build. While other investors think that the company's foundry business could be a good source of revenue and it could eventually give Intel a competitive advantage. I personally believe that Trump's America First narrative could make the second option work fine. Anyway, we will see what happens. Yesterday, America First trade was an investor's first choice. Dow Jones Industrial Index was offered yesterday, along with small and medium cap stocks in the US that should also see the benefits of America First. Now, in the FX, the US dollar index extended its gains, partly due to a Swiss sell-off in the euro, due to the French political crisis, and partly due to Donald Trump's threats to BRICS countries that they should use the US dollar and not have their own common currency to trade with each other. Because just imagine how having a common currency for these BRICS countries would be bad for the US Treasury that actually prints endless amount of debts without, however, losing any value. But anyway, the dollar yen tested the 100-day moving average support to the downside, that's near 149 level, but rebounded back above the 150 psychological level today. The bets that the Bank of Japan could announce another rate hike before the year ends keeps the yen bulls alert these days, but levels below the 150 level may be too enthusiastic for the bulls, provided the Bank of Japan's potential to deliver just a dovish hike that would eventually limit the Japanese yen appreciation. In the bond space, well, the 10-year JGB yield is pushing higher, that's for sure, and the Euro 10-year yield is pushing lower, and that's on expectation that the European Central Bank must cut more than otherwise to contain the renewed French political crisis and eventually to give support to the struggling European economies amid slow growth on the continent and a growing tariff threat from the US. So that should continue to support a further downside in the euro yen. In the US 2-year yield consolidates near the 4.20% mark, and the probability of a 25 base point cut from the Fed in the December meeting is up to almost 75% this morning, after the Fed's Waller said that he would back a 25 base point cut in the December meeting. Now, for those who are still interested and think that the data is worth looking and worth something in Fed's decision-making process, the US announced a set of better than expected PMI numbers yesterday, and also is expected to print a higher job openings data number for October and better optimism for December as well. Now, in theory, I say in theory, strong economic data should tame a part of the dovish Fed expectations, but the market investors want to see another 25 base point cut from the Fed in December, and the Fed will be happy to align. However, the latter limit the US dollar's upside potential is yet to be seen. In my opinion, if the economic data in the US remains strong, I believe not. Now, in the energy space, US crude gave back the early week gains at yesterday's trading session, as a failure to clear the $70 per barrel psychological offers brought in the top sellers near this level. Now, Chinese authorities' latest pledge to boost stimulus to boost growth, and the fact that the latest US chip restrictions on China excluded two big names actually triggered little enthusiasm among investors today. This being said, and it's important to note this, I expect the downside potential in the crude oil to be limited in the short run, and I also expect to see price rebounds on hope that OPEC Plus would delay or even scrap its plans to restore production later this week. So they will be deciding on December 5th. But I also think that OPEC alone could hardly turn around the market, and believe that the price rallies that we might see into the OPEC decision will offer interesting levels to strengthen bearish positions for those who continue to believe that oil prices will go lower from the actual levels before they go higher. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.